All right, trading day is just getting underway and that NVIDIA halo effect continues. Let's take a look at the broad market action. We don't see it, unfortunately, on the TSX because we don't have that same kind of AI pizzazz, at least on an index basis. But you're seeing it in a major way on the S&P 500 be a fresh record high if we close here. And for the NASDAQ, if we close at these levels, the NASDAQ 100 is already at all-time highs, but the NASDAQ composite would be at a fresh record high if we close at these levels, taking out the last previous high of 16,057 that we last saw in November 2021. Let's bring in Ann Sonders, Chief Investment Strategist at Charles Schwab. I mean, Ann, we can't get away from conversations about NVIDIA, even if you want to look at the other 490 stocks, right?
Yeah, and even with me, I'm not a stock analyst. I don't cover any individual stocks. I'm 30,000 foot macro. I can't get away from talking about it, but it's in the context of the broader market, and it's the magnificent one, so to speak.
It absolutely is, and I'd love to take it from that perspective, because you're right. You have to look at macro calls, you have to look at asset allocation, you have to look at diversification. It's so hard, though, as this behemoth starts to bleed into all of those categories.
It is, and what you are seeing is there's much more dispersion, even within the group, the so-called Magnificent Seven. In fact, that moniker came about because, at least last year, the stocks represented by that were the 7 largest stocks. But Tesla's now dropped out of the top 7. It's been bouncing between number 9 and number 10. Berkshire Hathaway and Eli Lilly leapfrogged both of them, which is why some are saying, okay, maybe it's the sensational 6. But even among that 7, we know Tesla's been an underperformer, ranked at near the bottom of the pack year to date. NVIDIA, of course, ranked at the top of the pack. But even Apple is ranked around, 300 something. So much more dispersion. And then even on a day like today, where you're still in sort of the honeymoon after NVIDIA's earnings, you see small caps really catching a bid. And I do think it shows that there are investors, there is money out there looking for opportunities outside of just that very small handful of names down the cap spectrum. We think you still need to stay up in quality, but I think that you're starting to see some early signs that maybe there is some interest in names other than just the obvious.
The Russell is interesting, and I'm glad that you brought that up, because it's been, there's been a number of head fakes, right? Is it the time? Oh, yeah. Are we going to get some outperformance? And we've been it's been very choppy so far in 2024. When you look at underlying reasons to be bullish for small caps or the Russell index, what do you see?
Well, first of all, an index like the Russell, which has 1,800 and change stocks in it, you can't analyze it monolithically. Small caps is not some singular thing. And I think specific to the Russell 2000, a lot of people don't realize that Russell doesn't use a profitability filter, which is why you still have somewhere in the 30 some odd % of companies that are some combination of zombie companies, which means they don't have enough cash flow to pay interest on their debt, or not profitable. An index like the S&P 600, which is not used as much as a benchmark, maybe because it's harder to beat, has a profitability filter. So I think, there are opportunities in small caps, but you can't look at it with a monolithic lens, because you've got a lot of really low quality, not profitable zombie companies in there. And I think that's the segment within small caps that you definitively want to avoid.
When you look at factors for outperformance, it's been all about momentum, and left in the dust yet again is dividend yield. This is even as, if you're a long-term investor, you have the opportunity to lock in dividend yield on stocks that can also possibly give you, outright appreciation.
But that's the possible part. There's a risk associated with the price component of a stock that even might pay a decent dividend. And when in the true safety of cash or money markets, you're generating a yield higher than a dividend yield without that underlying price risk, assuming you're holding it to maturity on the fixed income side. I think that's part of the reason why dividend yield, which in general might be seen as within the sort of quality basket of factors, is different in an environment where you've come off the zero bound and you now have reasonable yield. So I think that's why the quality factors this time, and momentum, by the way, people think of momentum when the word is used as sort of the high flying tech kind of stocks. Momentum is a factor. It's a characteristic. It means the stocks that have been working continue to work. You can have times where momentum is in energy stocks or momentum is in utility stocks. It happens to be in those higher growth type stocks in this environment. But the real places we've been emphasizing at the factor level are things like interest coverage, especially when yields are moving up, the strong cash flow, strength of balance sheet, but also growth type factors like visibility in terms of earnings, positive earnings surprise, positive earnings revisions. And that's, it's a quality wrapper, but they're not always the same factors inside a quality wrapper.
Well, I'm glad that you hinted at the ability to cover interest rates because interest expense, because this backdrop of the rally has happened at a time where those rates, the U.S. 10-year yield, has been moving higher at around 4.3%. At what point do you think it presents a headwind to stocks? Because normally it does.
So I think, we saw last year the big spike up in the 10-year yield from sub 4% to 5% that occurred from the middle part of July to the latter part of October. That was directly correlated to the only correction, full-blown correction we had last year, 10% or so in the S&P and 12% in the NASDAQ. And then, of course, yields plunged from 5 back down to under 4, and that allowed for the rally that began in late October. But interestingly, the initial couple months of that rally was very much in favor of small caps, of equal weight relative to cap weight. But then things settled down. And I now think there's just a lot more fine-tooth combing happening in terms of, okay, yields have picked back up again. They've gone from, call it, 3.8 and change to 4.3. I think there's more fine-tooth combing of where are the hits going to be, the zombie companies, what's their debt maturity schedule. And the same thing is happening, by the way, in financials with New York Community Bank and exposure to commercial real estate. We're not monolithically just sort of throwing everything out or lumping everybody in. I think this is an environment where you've got to look company by company and really take a more detailed approach to figuring out where the landmines are.
Liz.